Hi, everybody. Thanks for coming. Great to have everybody here. This is a 40-minute presentation. I'm going to try to do it in 30 minutes. And I'm not going to go over. And if you want to ask questions, it'll be 40 minutes. And if you want to leave any time, because you've been doing this all day, that's fine. But we're going to stay on track. I've got, so I'm Michael Steepe and Company, right? I'm based in Toronto. Natasha, my wife, works with us, and she's at the back of the room. If any of you met her, that's Natasha. And so I'm going to get going here, and the presentation is called Private Mortgage Funds Deconstructed, the Good, the Bad, and the Ugly. And it's largely going to serve two purposes. So this is for compliance. So it's already registered with CIRO for a compliance credit on the CE website. That's the one we did last year at the IAFP, and this is an updated version of it. And we're getting that final CE credit approval, but it's the same presentation. I'm going to presume that we'll be able to get you a certificate for the presentation you have today. So, right, Louis and Hunter. Let's go to, all right, so here's the first slide. So what I'm going to do is I'm going to do a general overview of mortgages. I don't want to get into it too much. I'm not going to get into credit like I did last year. I just have I've changed the presentation to add more liquidity issues and break down a bunch of liquidity risk in a bunch of different ways. It's a bigger topic this year than it maybe was last year. The risk was the same, but there's a lot more of it going on. So we're breaking that out. We're going to talk about just mortgage funds, and I do also generalize and talk about private funds. Generally, we do focus on U.S. private credit. That's our main fund. I have been doing private mortgage funds at the firm and private credit funds for 18 years. Steepe and Company is registered as an investment fund manager. That is our focus. In 1990 at a business school, I worked in the two developers when all real estate came apart in Toronto, that acute real estate recession. It's not nearly as bad now as it was then. People ask, it's not. And that taught me a lot. I saw a lot. I used to lend some money at the financial institution. I used to do some commercial leasing. I'm comfortable with the mortgage space, and this is really an extension of that. My first mortgage investment corporation client was in 1996 when I worked in trust. And they were doing some work with us, and that's when I was first introduced to it. So that's my background and why it is that I'm here today talking about private mortgages. So two basic types. You have a structure called the Mortgage Investment Corporation. It's a creature of the Canadian Tax Act, and it has a structure in that it's a corporation, but it acts really like a trust. All the income flows through. It's fully taxable, and the corporation doesn't pay tax any more than a trust would if all the income flows through. But it is specifically a corp. It is in the Tax Act. It has to be 50% residential, and you can't have U.S. mortgages in it. And it's for those restrictions that you also have, come on in, you also have other entities, which are just a mortgage investment entity, because you do want to have a U.S. mortgage, or you don't want to be 50% residential, and that's really the two camps. And I'm just covering off generally the mortgage space. What is it, about 300 mix in Canada, or mortgage funds, I should say, private ones in Canada. And they make up a sizable amount. So I'm going to keep on track and moving through here. So we're talking about the risks of private mortgage funds, and you really got to look at structure. This is a typical mortgage fund structure that really matters and gets to the risk of a lot of the conflicts of interest that you have when you have a private mortgage fund. At the very bottom, you have investors that enter into the middle square, which is the mortgage fund entity or the MIC or what have you. So everybody enters into that. That's a private fund. My point here is that you do not need to be registered in most provinces in Canada to run a private mortgage fund. You don't. There's no requirement for it. If you're raising capital, you do, but you don't need to be. And so the manager that may or may not be registered with the Securities Commission is then managing the money of your investors that might be in the fund. So then a typical structure is that you do need to be registered as a mortgage broker if you're going to be dealing in mortgages. In most provinces, you need to be registered as a mortgage administrator if you're then going to administer those mortgages. So you've got to be registered in that capacity, but not the securities capacity. The structure in most OMs is such that the manager outsources the selection of the mortgages that go into the MIC to the mortgage broker. And they're going to select what mortgages go in. And that's all part of from the declaration of trust to hiring the manager hires the mortgage broker that they own 100% of, and the mortgages flow into the mortgage fund. And that's the structure. And what's significant there is, one, you might not need to be registered, not to repeat myself, but two, the mortgage entity, the broker that they own, like a lot of the expenses of the fund can pay the operations of the mortgage broker and the marketing. But the mortgage broker owned by the manager will keep typically 100% of all the borrower fees for which I've never seen really any transparency and real reporting as per what that is. And that's where I'm highlighting the structure that exists with most mortgage funds in Canada. But we're going to get into details. So here is a liquidity scale. If I was smart enough, I could plot it, but I couldn't. So we just have it kind of set up. So I'm going to highlight 5 different aspects of a mortgage fund, characteristics that might add to more liquidity or might reduce liquidity within the fund. And then we're going to go through all of them individually quickly because we've got other things to cover. I hope I don't sound like I'm rushing, but I definitely want to get through everything on a timely basis. So leverage, mortgage type, mortgage payments, redemption restrictions, and the managers keeping the fees. These things are all significant to leverage. And there's others. There's other 3 or 4 things I could mention, like term to maturity, are they long or short, and other aspects. But I'm going to deal with these 5, and they'll cover off most of the point. So again, to use this example, which is liquidity, if you have leverage, I'm going to move to the slide specifically on it. So this is the same leverage slide you just saw. And if you have a lot of leverage, you're going to have less liquidity than if you have no leverage. Now, the fact is, it's pretty hard to find non-levered private mortgage funds or private credit strategies, but they do exist. But the point is, the more leverage you have, where the bank always has senior position to any unit holders on the assets, that if there is problems, the bank's got to get paid back first before you're going to get your redemption, and that's a fact. And so the more leverage, the more liquidity risk there is generally. And I'm just going to keep going through these. Debt tends to be more liquid than equity because you're higher on the stack. Then within debt, a mortgage is debt. If you had a first mortgage, it tends to be more liquid than a second mortgage because you're in first position and you have a clear exit strategy. You're in first position. And so if you hold second mortgages in a fund, that can be okay. But it does add to liquidity risk. And generally on a mortgage, if your first mortgage goes into default, then what your recourse when you're holding a second mortgage is generally that you need to cut a check to pay the first mortgagee out so that you make the whole thing one big mortgage. So if you have second mortgages, is the MIC or the mortgage entity prepared to spend that kind of capital, if there is a problem, to pay out the first mortgages? And you can see how that might put some liquidity risk on a fund as well if they had to act because the first mortgage goes into default and they're in a second position. Other liquidity. I could do a whole 40-minute presentation on the significance from a fund accounting standpoint and everything of payment in kind, PIK. But I'm not going to do that now. We'll talk about it a bit later. But basically, if you have a mortgage fund that's typically doing ground-up construction, then there is no liquidity. Like there's no yield coming from anything. There's no building generating. There's no billing from which to charge leases. You're still building a building. So the way the funding tends to work on those is you might set up an interest reserve account or something, but they tend to be PIK, that the $20 million construction loan will accrue to $28 million over a couple of years because no physical payment's being made. And the payment, the $8 million difference between the loan amount when you start and the loan amount when you pay out is the equivalent of what the interest rates are of the payments that aren't made that are just accruing to the loan amount. So there is no payment being made on many, many mortgages that are held within that. Now you're still getting distributions and you're still getting returns and the fact sheet is still showing you're doing okay based on the fact you expect to collect your $8 million when the building's built, but there's no physical payment being done, often. Not always, but it is a common. We like principal and interest where if you buy a car, you got 36 payments, so that's a self-amortizing loan. At the end of 3 years, you own the car and there's no loan. So that's a self-amortizing loan. And so we prefer that because it adds liquidity because there's a lot more cash coming back into the fund. And so that's the significance of the payment structures that exist and the impact on liquidity within a fund, let alone veracity of NAV, which is another issue. That if somebody's making principal and interest payments on a $20 million loan, it's a pretty good test if you got a payment that month, given the size, that your $20 million loan is probably still worth $20 million. If it's a PIK loan, it's a little bit more nebulous as about whether it's actually $20 million, and you might not know if your loan is $20 million worth or not until it actually comes due in 3 years. And that's the nature of that lending. So we like to know right away, and it adds liquidity. The high redemption terms. So the higher the redemption terms, so one manager we allocate to, minimum $1 million US. It's a retail fund, minimum $1 million. 100% first, no leverage. And the terms are way tougher than I would see in Canada in that they say, one, you're not going anywhere for a year, one hard lock, and then you can only get 25% of your money out in a quarter. So it's going to take you 2 years minimum to get out. Now that's 6 to 7 month term, average $1 million, 3-bedroom house, the garage in a big US city, non-levered. They're not doing 30 days. They're doing 1 year plus 4 times a year, maximum 25%, take you 2 years to exit with your $1 million minimum buy-in. So the higher the bars at the top, at the front, the bigger the barriers are in terms of your exit, the more liquidity you're likely to have later. It's a reverse. If you have a very low bar that everybody can easily step over, you actually increase future liquidity potential problems that you would have in a fund because of that. So, keeping the borrower fees. So this is common. So, most mortgage funds keep the borrower fees. Now this is not to say that the person running the fund is somehow nefarious or doing something wrong or whatever. But I do not, and we do not ever allocate to any private credit fund or mortgage fund in the States where we allocate all our money if they keep a dime of borrower fees. Because my experience is that it's a conflict of interest that's so outrageous, it's very hard to manage. And that's in good times. And then during times of stress, you've already got this huge conflict of interest. And what are we talking about? We're talking about a 1-year mortgage that's just called simple interest, 10%, and a 2% fee up front. So that 2% fee is going to the manager. The reporting on that is not really clear to you. And all mortgage funds would typically also allow for you to buy a secondary mortgage. So it would allow the mortgage broker to buy a 11% yielding mortgage and put it in the fund at 9% and keep the 2% fee. The transparency on that is really nebulous. It's really hard to see in the balance sheet when these kinds of transactions take place. And so the conflict of interest creates liquidity risk. The very cash itself that doesn't go to investors in the fund, it eats away at liquidity risk for a lot of reasons in terms of confidence of the manager and the conflict of interest. And these things can conflate. They can all come together in different ways that matter more at certain times during stress. Do not allocate, we do not allocate to private mortgage fund that keeps the fees. And the fees, you should look at it. So you got your management fee, you got your performance fee. We allocate to a manager that also has a top-up, a catch-up. And they're big fees. Like, they're not cheap. But at least they're there, and they're absolute, and this is what they are. And then all the mortgage origination fees go to the fund. And at least it's clear, at least it's reporting, we can see what it is. But you got to add back in those borrower fees that are going to the mortgage brokerage that you don't get reporting on. You still need to go ask for that reporting. You need to see what that 2% is, add it to the management fee, add it to the performance fee to know what the total cost of the loan is or what the fees are. And you also want to know what the guy's paying. A 10% yielding loan where the guy pays 10% or 12% where he's paying a 2% fee or even a 13% loan, these are materially different risk profile mortgages going from 10 to 13. So you need to know what is the guy willing to pay. It tells you the most about what the risk of the portfolio is. If the mortgage broker is keeping the fees, you don't know what the guy's paying, typically. All right. What does liquidity look like? So what if you're not levered and you're only senior or 96% senior and you're short-term loans and you're not keeping the fees and the majority of the loans are principal and interest self-amortizing in, let's say, 22, 24 months? Well, this is the reporting we get. So the top line is 300 million, then 250, then 200 million. And this is quarterly time, and this is Q2 2025. And so a manager we like gives us this reporting. We need this. And when I got calls 3 weeks ago about liquidity, I'm able to send this slide and say, okay, here's the reporting we get. So in Q2, the amount of money that came back, because they're short-term loans, they're hard assets, they're real assets, they turn over, and the principal payments with interest payments on the loans that come in, they had $240 million of money come in Q2 2025. They had redemptions somewhere around 25 or 28 or 30 million or whatever. And I can see what that liquidity is. I can see what it is. It doesn't mean it's guaranteed. Doesn't mean it can't go away. It doesn't mean liquidity risk is somehow eliminated. But at least I've got the reporting to know I can send that to my pension clients that are asking, and we can have a shorter discussion because this is the reporting we get. And we do love the reporting we get out of the U.S. We are, like on the mortgage fund in the U.S. that we allocate to, sorry, I'm just going to clean my nose up here for a second. And excuse me. And there's a lot of things here. So let me just touch on them quickly. So I mentioned earlier you do not need to be registered to run a mortgage fund. But in the United States, with one of the funds we allocate to, that we like it for this reason, if you have more than 2,000 investors in the United States, then your private fund doing private loans to private companies is regulated by the SEC almost exactly the same as a Canadian mutual fund in the public market is regulated. Complete disclosure, independent board that's really independent. And complete disclosure means that you could go on the SEC website and see all 199 mortgages that make up almost a $2 billion portfolio and who's borrowed the money at what rate and terms. And the manager hates it. And Donald Trump is saying, let's do it not quarterly, but semi-annually is his most recent discussion that he's saying on that. But right now it's quarterly. So we are getting awesome reporting, transparency, oversight, and this is part of the reasons why we gravitate to the States. So there's just a quick touch off here, but one of them I want to really do is the Interest Act. So that's statute law in Canada. It doesn't matter if you're a private fund or a bank, you can't charge defaulted rates of interest. So that means that you have to charge the same rate on a defaulted mortgage by law as a non-defaulted mortgage. And what's material about that is if you're investing in a pool and the mortgage is going to default, you have more risk as an investor. It's kind of nice if you can accrue at 20% as opposed to have to stay at the same 8, 9, 10, 11%. The law is, there's no interest rate act law in the United States of America. When a mortgage goes into default, the American Association of Private Lenders would say, I don't know, something like 22 or 24 is a responsible level of default interest, or whatever that is. But what I'm getting at is that it provides our American mortgage providers all these tools. Non-judicial states, like during COVID, but even not during COVID, when you land in a non-judicial state, you would foreclose on the courthouse steps. You don't go into the court system. It's a much shorter leash. And a first mortgage in BC, you've maybe got to go to court. It's a little bit more nebulous. In Saskatchewan, it's long too. So even a simple security like a first mortgage on a 3-bedroom house with a garage in a major city is a materially different security depending what the laws are surrounding your ability to act on your collateral. And that's one of the reasons why I like the States. So there's a bunch of reasons we like the States. I like the higher yields. That's great. There's no HST on performance fee and on management fee. And so that's nice because in fund accounting, HST is a dead expense. You can't write it off to make your trust more taxable. And so just investing directly in the States and avoiding HST, yeah, I can buy my fund just because there's no HST, but the point is there is some materiality to it that's non-deductible. So I'm going to move on. The gap audit that in the US that requires third-party evaluation of the private assets that the IRFS audits that we don't need to. We love that because it is material of needing third-party valuation as part of your audit. So I'm trying to move on here, but there's all these points. So I'm going to move on. I think I've covered them all. Sure. There was the last point there. So the NAV, there's whole like is your NAV real and whatnot? We're going to get to that and all that discussion. But in the States, the SEC has imposed a discounted cash flow model that they must use on these private funds that say what are bond yields, what are yield spreads, and you have to incorporate that as a component in your NAV. So there actually is market volatility in the private fund NAVs where we allocate to in the States based on spreads and based on yields that is implemented into the NAV process. This is a marketing piece from a company we haven't allocated money to, but I like the reporting. This is 100% first mortgages. It's about $3.7 billion first mortgage fund in the States. And I like these guys, and I can't say their name because the SEC also prevents all my clients in the States from putting anything in the public domain that says their name or you'd be offside with the SEC. You're not going to find a fact sheet. You're not going to find a deck. You're not going to find a strategy. They're not allowed to. So there's material differences on both sides of the border on securities, and that's one of them. The contracts I would have with any of these are such that I can't post stuff on LinkedIn, and if this is going to be online, I can't say their name, and that's why the name's not here. But here's what we're saying. I would suggest that the fact sheet of this private mortgage fund provides more detailed information than investor needs than most OMs do in a Canadian OM. And so I'm just going to go down. So this one, where we focus on non-levered, this one is levered. I'm also suggesting that there's a lot of leverage in a lot of mortgage funds in Canada that you might not be aware of. And I'm going to start just at the top. So $3.7 billion, term to maturity 23 months. I'll skip over floating rates 99%. Average loan is almost 30. Weighted average, so acquisition, refi, and construction. So they're breaking down what they're lending on. So if you're going to buy a building, 41% of the $3.7 billion goes to funding buying new purchase. 52 is refi. Somebody owns the building and they're extracting money out of it. There's risks on that too, but that's 52%. Construction is 7. I just don't see this breakdown when I look at fact sheets on mortgage funds in Canada. I love it. This is levered. So the average spread on loans that they're getting out the door is SOFR plus 4.3. They're borrowing money at SOFR 0.235. They are levered. Gross 4 times leverage, net 2.4 times leverage. AB, I'm going to talk to in a second. So they're highly levered. It's going to add to liquidity risk. But this is all first mortgages. This is all multi-unit residential. This is all like established stuff that's doing what's called bridge to HUD. It's a short-term lending where the seniors home or the apartment building that's in here is going to go to the CMHC equivalent called HUD. And so they just need the building stabilized for 18 months. They want to get it, like all the rents as high as they can before they go in the States and get a 30-year mortgage. They're going to make sure they have it working. So that's bridge to HUD. So there's 7% construction, but basically these are existing buildings. AB loans. You have your first mortgage, you put on your fact sheet, it's 100% first mortgages, and that's technically correct. It's technically correct. And I'm saying this is first mortgages, but at least they're saying AB is 38. You have a $10 million mortgage, you cut it in two, you got two $5 million pieces, one's A and one's B. B's in the portfolio, it's still technically a first mortgage, but you're selling participation in A to somebody that's now at like 30 or 35% loan to value because they're the last loss. So you really take your first mortgage, when you cut it in two and make it AB, you make it like a first and second from a layman's standpoint because you're now in first loss position because you've effectively taken your first and cut it in two. The $5 million that you sell participation to goes into the fund and that's leverage out the other side. And so all the mortgage funds tend to do AB lending, not all. And that's tranching is what it is. And so it's really material to understand that you can look at a fact sheet, see it's 100% first mortgage, technically it is, but if you got the whole thing tranched into A and B, the fund has got an obligation to pay the 5% yield or whatever they're doing on the money that they've sent out, and there's leverage there, and you're kind of in second position. Where am I going here? I think I've covered off this stuff. I love this term. I've got, where is it here? It's, yes. Weighted average remaining term to fully extended maturity. I love that. So if you're going to try to sell a mortgage fund, you want to be all first. If you want to raise money, you want to have short term to maturities because that gives you a sense of liquidity because things are turning over. But if you actually look at how many mortgages get extended, if you look at how many mortgages get renewed by the same buyer, if you look at all that, then you're looking at, okay, when the guy gets the mortgage, or the lady, or the person, or the company, by the time they're finally gone, when it's all said and done, how long is that? And it's materially different than the first term that got renewed once or twice or extended and everything else. But of course, in the fact sheet, I want to say, you know, when we do the loan, the average term is like 7 or 8 months. But the fully extended term of maturity, I don't know, might not go from 7 to 23, but you get my point. But I love the reporting. I love the reporting on the fact sheet. And this is why I follow these guys, and this is why I highlight it with you guys. I think that's pretty much this. I'll move on. Let's do, planners, just a little basic math. And you say, okay, loan to value. Now, in the mortgage world, there's hardly a term more nebulous than loan to value. Maybe only default, but we'll get to that in a second. So this is a very nebulous term. So here's the math. This is a real data from a company I've done some work with. In fact, I was invested pre-COVID in this private mortgage fund. And this was about $400 million in size, and it's just standing apartment buildings. It's a mandate you wouldn't be able to fill in Canada, I would suggest, because it was no land, no construction. It was just standing apartment buildings in major cities. Again, bridge to HUD, just that short term. The guy needs the money to stabilize the building before he goes and does permanent long-term financing. Now, what should I highlight first? Let's just do the math. So the average is 71% loan to value. Now, that does not mean that the whole portfolio can drop down by 29% and you're still okay, unless every single mortgage in the portfolio is actually at 71% loan to value. If that isn't true, then it's not true to say that the whole portfolio can drop by 29% because you're at 71 and you're still okay. Let's break down. We have how much percent is less than 51%? 1, so hardly anything. What percentage of the portfolio is between 50 and 60? 20. Between 60 and 70? 28. Between 71 and 75? 9. Now again, I love the reporting I get from this private mortgage fund and from this group. What percent of the portfolio in an all first only, non-levered, no land, no construction mortgage fund that will not lend by mandate over 75% loan to value? That's their mandate. What percentage of the portfolio is over 75%? Right. What's the year? July 2024. Every single apartment building in the United States of America went down like 20 or 25% because interest rates shot up. And of course, if they're just doing the same reporting they do all the time, they're just sending me the data, and their fund is not investable at this time. It's like they got, now, they went down from typically like 7 down to about 4%. They're still profitable, they still came out, but 42% of the portfolio is over 75% loan to value, and if you invest in it, your risk is that 25%. So if there was a recession, if things did turn or went worse, I mean, that's the money at risk right there. And this is an example of the kind of reporting. So there's 2 points, right? There's the average loan to value that might not really give you what you need. You really want to ask what percentage of the portfolio is over 75% loan to value to really give you an idea of what your risk is at and what dollar is at risk. All right. So what's the number one question everybody asks me over the years of private mortgage funds? Have you got any defaults? Okay, default is a highly subjective term with no one definition. And it's the wrong question, because every single loan document, whether it's private credit or private mortgage, would allow the lender to unilaterally extend a loan holiday at their choosing, much like during COVID, when you actually read things. So there's nothing nefarious about that. It's just you have the ability to do that. So there can be situations where you might not want to have defaults, and you could unilaterally say, okay, you were giving me principal and interest payments, and I'm just going to make it PIK because I can. But it would also help you manage defaults, because now that's not in default, because you can actually change the terms, and hence that's the question you want to ask. You want to say, have you modified any loan terms? It really gets to the underlying, since the manager's got the unilateral ability to change those terms and avoid defaults. And so it's good to ask defaults, it gives you an idea, but the real root of where you're trying to go here is, okay, have you changed anything at the lender level? Everybody okay with that? All right. We're moving along. Okay. NAV. Oh my God. So you have maybe a non-registered good guy creating securities called mortgages. A mortgage is a security, and he doesn't need to be registered. And then he's going to take that security that has a huge amount of input, human input, from which there's always some error, but what's the rate, what's the term, how long? That's a security. And you're going to take that one security, add it with the other 99, have 100 of these private securities that you've manufactured, and that's your fund. And then I'm going to say, I'm going to price the fund. I'm going to say, okay, I changed it, modified a couple things, but they're technically not, I went to PIK, but they're not default or this or that. And so then I'm going to say, this is my net asset value. But again, that is really risky. And so I'm highlighting here the importance of having a third party striking and determining what your monthly NAV might be in a fund. It's a requirement. It absolutely is for reducing risk. Like, you need to have a third party doing that. That the conflicts of interest that can exist, especially during times of stress, of saying, I think my fund is still worth $10 NAV, is really a lot. So to mitigate your risk, I'm just highlighting what NAV construction is. There's still lots of rules around it. It's accounting. You're wrong to think that these NAVs are all not real. That's not true either. That's oversimplification. There's a lot of rules around them. There's rules of a private fund. If you're getting paid and if you're making payments, you just keep it on the books at book value. Okay, your $10 million loan is worth $10 million. If you think you're going to get paid the interest, or if you're going to get your $10 million back, If you're not trading these, if you're not in the business of trading mortgages, you would keep that at book value. And that's what it is. So the manager, if there's a real professional manager running it, he's really only marking this mortgage down, and that's because they think, oh, I didn't make a payment, I need a provision, I need to hold back $1 million from my distributions because I think I'm only getting $9 million back, and so that is really just marking them down. But there's a lot of human input on that. You gotta have a third party striking NAV. You gotta have somebody else getting those details, and you can't just do it all in-house. All right, we are zipping along. What's my time here? It's so interesting. Right on.
You're right on track.
Right on. Okay, so of all the unfortunate, sometimes terrible front page news stories on private funds, there are some real basic rules to follow that will help you avoid 98, I just pull that number up, or 99 or 97, the vast majority of bad front page news stories. And you don't need to be a CFA. And you don't need to be a fund accountant, and you don't need to have lent money, although those things all help. But if you follow these things, this really eliminates so much risk. So the first one is, if they're not registered, just pass. And so you don't need to be registered in Canada. There is a $8.9 billion private asset management firm, and they don't need to be registered. They're not breaking any rules, and that's the way it is. But I would suggest that there's no meeting of the minds. If you're trying to do what's best for your client, you're trying to have your own fiduciary and stuff like that, at what point do you say, well, maybe we should be registered because, we have thousands of clients, we manage billions of dollars, maybe we should get a registration, but there is no requirement. So it's not that they're breaking any rules, but I would suggest there's no meeting of the mind in terms of what management is thinking and why they're there. Not why they're there, that's not proper to say, but you know what I mean. If the manager keeps the board fees, there's too many good alternatives that are available now. This was standard, this is how it was, this is the way it's always been, that's okay, and if you created a new mortgage fund anytime recently, you just did what all the other competitors do, they keep the fees. But everything changes, and you're not buying a Canadian equity fund at 250 basis point management fee anymore. And every industry will go through change, and this one will mature too. Fees will come down, and conflicts of interest will go away, and every mortgage fund that's keeping the fees and doesn't have transparency is going to go away. It just doesn't make sense. The conflict is outrageous, and this is part of the maturing of the marketplace. You got to have a third party striking NAV. I already mentioned that, right? The importance is just so important. And by the way, if you invest in a fund because you're okay with it, and they don't do that, what happens if there is some stress? All these things add up so that people don't get nervous about your NAV and then come and run to get the money out. So long as somebody has all these other structures, you help mitigate the confidence in your NAV and that it's worth what it is, and maybe help reduce people coming to get their money when there's other stresses outside of your control in the marketplace taking place. Redemption terms. Remember, we want to have higher restrictions up front that reflect the assets. Debt tends to be more liquid than equity, but if you have an equity real estate fund and all the leverage that's in there, and you're offering 30-day liquidity, I'm suggesting that is a mismatch from day one. It's a building, it's levered, 30-day liquidity. That is a mismatch. So maybe you want to avoid that because just logically, it's got to kind of add up. Here's what nobody underwrites: the wholesaler, the promoter. I'm here, I'm buying the stage, I'm telling you, okay, we know this stuff, and maybe you want to do some business with us, I hope so. But if I'm talking about liquidity risk, it's because it's firm threatening to me. And if I'm using non-levered funds, it's because I don't want to have to gate the fund. That's firm threatening. And that risk never goes away, but everybody that comes into my fund comes through me, and there's no way anybody could possibly misconstrue the fact that there are liquidity risks in my fund. And that's how it is. And I protect all my existing unit holders with that, and all future unit holders with that. The risk that you can't get your clients' money back when they might need it most never goes away. And everybody hears that from me. And if you go to allocate, that's what you got to think of in terms of what's appropriate, how much, and what portions. That risk never goes away. Even if you're not levered, even if you're senior, never goes away. But I would also suggest you can mitigate a lot of that if you are in that more conservative camp on the alternative side. The wholesaler that's saying, And the wholesaler might not know. Like the wholesaler might not really understand the conflicts of interest of the manager using the line of credit at the existing unit holder's expense to benefit those that aren't in the fund anymore to get out. That maybe as an investment fund manager, where one of my 2 jobs is to treat everybody fairly, I don't want to do that because it doesn't really seem fair that I would incur that cost to my existing unit holders. So maybe the wholesaler doesn't fully understand that fiduciary and that treating everybody equal at that level. But if they're saying, look, we got a big line of credit, 30 days, no problem, you can hit it, pass. Because there's a misalignment with the other people that might be investing not knowing and they're in that fund. And so these are the 5 basic, you follow this stuff and you will avoid most of the hassles. And it doesn't have to be all that complicated. And so that's what we do. And so in the States, if we're allocating, of course they're SEC registered, of course they have a custodian, of course they have all these other things. So if we're a tiny little asset management firm by all comparisons, just quickly, we are investment fund managers that requires more registration to run an investment fund. Investment fund has more oversight, other requirements, I won't get into it. We have a third-party striking NAV. We have Fidelity as our custodian, holding all our cash, so the fund custodian. I wouldn't have pension clients if we didn't have a custodian. I'm only allocating to registered SEC guys in the States that also have a custodian. And that's just where it starts. That's just the basic structure and avoiding the conflicts of interest. But these options are available. And this is not part of the compliance, so we're open to questions. This is just an example of a couple managers we actually do allocate to. The left is 100%, the right is 100% first mortgage fund, hard money lender in Connecticut. They do a great job. Again, if I do a redemption, I'm not getting all my money for 2 years because that one's 1 year hard lock and 25 afterwards. The one on the left is regulated just like a public mutual fund is in Canada. And you know what? There's 0 withholding tax. The 1940 Act RIC structure, no blocker, no Cayman. Our fund is a single investor. There's no withholding tax. It's really clean and simple. And I encourage like a direct investment. My Canadian fund does not layer on fees. I get paid out of the States from these guys anyway, so I'm agnostic. Invest with us here. If you need an RSP, you need a mutual fund trust, fine. Or if you want us to hedge currency, fine. But the other manager on the right, they've created the Canadian dollar series for me in the United States. So my clients that want to get direct access but want to use Canadian dollars can do so directly in the US that way. And this is what makes sense to me for alpha in structure. So if you need what we have, great, we can do it. If not, you can go. I'm not conflicted. Go direct, invest with us. But either way, I want to thank you for coming out. And that's my presentation. What's my time? Did I go over or are we good?
We got about 1 minute left and we got some space between our next presentation. So if we have questions, we can go for it. I see Sham at the back here.
Could you explain the A-B concept again? I
Sure. Okay. I've been asked to explain the A-B concept, and then I'm not going to keep you after that because it is late and you've had enough. You've been here, but let me do the A-B. So it's tranching. You take a $10 million mortgage, and it's financial engineering, and you're going to cut it in half. You're going to have 2 $5 million pieces. You sell participation in the most senior piece, which is, let's say, 0% loan to value to 35% loan to value, as opposed to B that's 36 to 70, let's say. So the bank loves that paper because they're down at 35% loan to value. And the bank says, okay, here's the $5 million, but I want to get paid 5% for that. So the fund has an obligation to pay 5% to that paper. That $5 million comes into the fund and is used to fund another mortgage. It's leverage. But the mortgage broker is also making fees at both ends of that, right, on the transaction side. And the fact sheet says you're 100% first mortgage, and nobody tells you how much leverage is in it on the fact sheet. Does that make sense?
Yes.
Awesome. Yes, sir.
Who's your quant? Oh, hold on. Who's your quant guy?
Who's my quant guy?
Yeah.
Well, we have a really awesome analyst who's also a trustee on the fund, who's done no less than 300 private markups on privates, and his name is Bill McNarlin, charter holder, and he's out in Cochrane. And Bill and I worked together at Industrial Alliance like 20-some years ago, and so he's a key part of the whole team. Martin McCambridge does our hedging. He's, I think it's okay for me to say his name. Anyway, he's also a charter holder. He's ex-managing director at Royal Bank. He's way overqualified to do our hedging, but I ride bikes with him all the time. He's a buddy of mine, and so I'm happy to have him on board. Ian is part of our team. Ian's a CA, and he helps us with the oversight when somebody's doing our NAV, all that, and HST. So this is part of our team if I'm expanding, but that's, I don't know if I have a quant, well, Bill would certainly be a quant guy, yeah.
What, because you mentioned the registration with the portfolio or registration with the securities regulator. So what would happen, or like what does registration do in terms of like what extra commitments do they have to follow, or transparency, or whatever the case is?
Okay, so if you're registered, then there's like just an endless, continuous requirement to meet the compliance of the OSC. Like so that would include things like, okay, so what expenses go to the fund? What expenses do I pay? There's like very specific, and are we following the OM to say what we do and don't pay? If that's one example. So the fund is an investment fund, so we also file, every time there's exempt trade, you got to file with the Securities Commission there's exempt trade. We've got, as an investment fund, so we have to send audit financials, we have to send semi-annual financials. They don't have to be audited, but we have to send out semis. You have to do quarterly reporting. And so there's a lot of structure around that, let alone as an investment fund manager, the quarterly filings I'm doing, the annual audit of Steepe that I'm doing, and the surveys that I'm doing that the OSC makes me do, and the fees I got to pay later today, and all these other requirements of registrations are real, and there's capital requirements. I got a minimum amount of capital that I got to keep in a bank that I never touch, that anybody that runs a firm would understand and know. And so these are all like good rules. Like these are good things to have to protect the public. And there's no requirement in most provinces to be registered to run a private mortgage fund. Yeah. Okay. So guys, thanks again. I appreciate it very much. Thanks for coming.
Thank you, Michael.
Thanks, everybody. All right. Good. Thank you for saying so.